In just the last few weeks, the narrative surrounding Google stock has completely shifted. If we look at the last year, yes, they're still trading pretty flat, but in the last month, they're now up around 14.32%. And keep in mind, it was just mid-April when the stock was trading as low as around $146 per share. But even with that being said, in early February, they were trading over $205 per share. Now, what's interesting about this is despite this recent run-up, Google stock is still trading at a multiple that is cheaper than its historic average. If we look at the price to earnings ratio for Google charted out over the last 5 years, we can still see they're trading at a pretty low valuation multiple compared to how they have historically traded. And what's interesting is if we look at the average Wall Street estimate for Google stock in the next 12 months, they're still estimating around 11% upside with a price target of $201.14 per share. So the question is Google stock still attractive at its current prices despite the recent run-up over the last month? And Google stock's a stock I've been covering on the channel pretty frequently over the last few months, and I put out a video about a month ago discussing a Barron's article where they stated they believed Google was worth $260 per share, and it was actually a pretty solid article. And what they did to get to that price point was a sum of the parts model. Now, basically what this means is they broke out each of the business segments for Google and gave them a fair value. So for example, we have Waymo, Google Cloud, YouTube, and Google Search. But I didn't want to just take the article at face value. I actually wanted to back into how they found these numbers. So if we come over here, we can see that's exactly what I did. We can see Barron's was valuing YouTube at about a 22 times multiple. They were valuing Google Cloud at about a 16 times multiple, which is similar to peers, so that makes sense. And then Waymo's a little bit more difficult because obviously it's not profitable yet, but they were valuing it at about $300 billion. Now, Waymo's a little more controversial. Some people will think this is way too high and some will think it's way too low. And we'll touch on that here in just a moment. Now, if we just take these three business segments, we can see the value of them is about $1.4 trillion, but the market cap of Google is currently sitting close to $2.2 trillion. So obviously, we can back into how the market is currently valuing Google Search, and that is the key right now. Everybody's concerned with Google Search. Is the moat eroding due to AI? And again, we'll touch on that more later, but let's finish with this valuation. We can see this means the market is currently valuing Google Search at about $775 billion, and we got that simply by taking the market cap of Google and subtracting out the other parts of Google. Now, what's interesting is at the time that article was written, the value of Google Search was estimated to be about $550 billion, meaning it was trading at about 11 times earnings. Now, obviously, like we've already pointed out, Google stock has gone up quite a bit in the last couple of months, meaning it will have a higher valuation right now. But what's interesting is even at a Google search valuation of about $774 billion, that would give them a relatively low earnings multiple, at least comparatively speaking. Let's look at an example. Let's talk about Pepsi stock for a moment. And I know Pepsi is in no way similar to Google, but look at the forward PE ratio of Pepsi, sitting at 16.35. This is a company that's growing earnings very slowly, maybe 2 or 3% over the next few years. If we look at a company like Coca-Cola, again, not similar to Google in any way, and it does have a strong brand, but their forward PE multiple is currently sitting high at about 24.19, and again, maybe they'll grow earnings at about 5 or 6% over the next few years. So what's the point I'm trying to make? Basically, there's companies with far higher PE ratios growing earnings at a much slower rate. And recently, Google gave us the data to prove that. Their Q1 2025 earnings report was absolutely critical. Everyone wanted to know what was going to happen with Google advertising revenue, Google search revenue. And let's go ahead and take a look. If we look at what happened to Google search revenues year-over-year growth, it came in at 10%. So again, let's talk about what we just discussed. Pepsi's growing earnings at about 2 or 3%, Coca-Cola maybe 5 to 6%. Google's trading at a much lower multiple. The Google search portion of the business is trading at a much lower multiple and still grew their earnings at over 10% year over year, a double-digit rate. So even with the recent run-up in price, does this still mean there's some opportunity? Well, let's go ahead and discuss some of the recent news surrounding Google over the last few weeks. Well, to start out, OpenAI has signed a deal with Google Cloud to help meet its growing computing needs for training AI models. Now, why is this significant? Basically, Google Cloud's going to provide additional computing power to OpenAI, but this will not replace OpenAI's existing deal with Microsoft. OpenAI obviously has massive computing demands, and it looks like they might be diversifying its cloud infrastructure, and so this is good news for Google. And at the time this news was released, Google was up about 2.5% on the day. And then we have more news on Waymo. And in some ways, the Waymo portion of the business is as controversial as Google search. Like I mentioned earlier, some people think that Waymo being valued at about $300 billion is way too high, and some think it's way too low, especially for a company that's really not even profitable yet. But the recent news we saw surrounding Waymo was again quite bullish. We can see they're now predicted to hit $6 billion in bookings by 2034. Now, here's one of the things we have to remember about Waymo. Yes, they're not free cash flow positive yet, but take a look at Tesla stock over the past decade. If we plug in the stock ticker up here and then indicate that we want free cash flow, I'll hit enter. All the data will automatically load into my spreadsheet. And like always, I'm able to import stock financials straight to my spreadsheet with the help of the ticker data add-on in Google Sheets. You can get access to that and any of my other spreadsheets at tickerdata.com at the link in the description. But when we look at Tesla free cash flow, we can see free cash flow was negative for a long time. Quarter after quarter, they were losing $300 million, $500 million, or even over $1.5 billion in free cash flow every single quarter for years. And the journey for Waymo will be relatively similar. Now, let's talk about what most claim to be the major threat surrounding Google stock right now. It's the threat of AI, and like we've already seen, it really hasn't played a role yet in cutting into those revenues. We saw Google search revenue increase 10% year over year, but what will this look like moving forward? And I think this is where a lot of people begin to make a major mistake in not counting Google in the AI race, which is pretty crazy to think about. For example, if we jump over to the LLM leaderboard, there's a couple things we have to keep in mind with Google. If we scroll down and look at best in reasoning, we can see Gemini 2.5 Pro comes in at number 1. If we scroll down and look at best in adaptive reasoning, again, Gemini 2.5 Pro comes in number 1. If we look at best overall, once again, Gemini 2.5 Pro comes in at number 1. Now, these leaderboards are constantly changing as these companies make major updates to their AI, but I want to be completely clear. Google is a major player in the AI race, and to discount them out would be a mistake. So is there risk with AI? I think the obvious answer is yes, but how big of a threat is it? Right now, when we look at the revenue growth that Google Search is seeing, it's obvious it hasn't impacted the business yet, and along with this, Google remains a major player in the AI race. If the business is being disrupted, the underlying fundamentals definitely don't display this. And keep in mind, Google's in great position to heavily reinvest back into the business to continue to grow their AI capacity and their capacity with Waymo. I mean, if we just jump over to the balance sheet breakdown and look at Google stock, just take a look at that debt to assets ratio. It's sitting at 0.06. The company at the end of 2024 had over $450 billion in total assets, and total debt was only $25.4 billion. So this is virtually one of the healthiest balance sheets you're going to see, and if we just take a look at the company from a dividend breakdown perspective, which I know seems silly, but here's what I want to point out. The company's only using about 10% of their free cash flow to currently pay out a dividend, so virtually all of the capital they have is being reinvested back into the business, which also in turn will allow them to grow that dividend at a higher rate in the future. And then of course, if we jump back over to the stock screener, let's come up here and plug in Google. Here's one of the things we absolutely have to point out. Look at the return on invested capital over the last 4 years. Now again, remember, this is telling us how profitable are the projects the company is reinvesting their capital back into. And as a baseline, we typically want to see 10%, and high quality companies can get up to 20% or higher. Google's been above 20% for the last 4 years. This is a good sign. So I think now we do understand some of the risks surrounding Google, but there still appears to be some upside potential. So just how much upside are we talking about? Well, we can jump over to my sensitivity analysis and find out exactly what to expect if we come up here and plug in Google. Again, to calculate our expected future returns, we need to project our future earnings growth, and we need to project our future PE ratio. And fortunately with ticker data, projecting the future EPS growth is quite simple, because what we can do is use a ticker data function that will automatically import the average analyst estimate for earnings per share through the year 2029. And what we can see once we've done this is the projected EPS CAGR on average is about 14.36%. So earnings are still projected to grow at a very healthy rate. That's the average analyst estimate. So we'll look at a few different assumptions. We'll look at maybe a bear case and a bull case, but let's start with the average and come up here and plug in 14.36. Now we need to project our future PE ratio. Now remember, on average over the last decade, it's sitting about 29.04, but we do have a huge outlier here in 2017. So if we remove this, it comes down to about 25.86. Right now, the trailing 12 months PE ratio is about 19.74, which is about 24% lower than the 10-year average. So again, let's go with a midpoint. Let's say the PE ratio recovers some, but not all the way back up to where it was. So we're being a little more conservative. If we enter a PE ratio of 21, what we can see is when we come down here to 2030, we'd come to a share price of $393.64 per share, meaning a total return of 117% and a compounded annual return of 13.8%. So simply taking the average EPS growth projection and a little more of a conservative PE ratio, all of a sudden you're looking at a stock with pretty attractive return profile. But let's go with a more conservative case. Maybe EPS growth is significantly lower at about 11% and the PE ratio never recovers and stays at about 19. Even in this scenario, I think the total return still looks somewhat attractive. You'd be looking at average market returns in a bear case, which typically speaking is a pretty good sign. And then what's the bull case? The bull case is that Google remains a major AI player and Gemini integrates with their ecosystem very well. Let's say if that's the case, we go with a projected EPS growth rate of 15% and we'll say that the PE ratio recovers all the way back to their 10-year average at 25.86. And just look at these returns we'd be getting by 2029, by 2030, a total return of about 175% and a compounded return of over 18%. Keep in mind, this doesn't include dividends, which right now, obviously the yield is small, but I would expect to see decent dividend growth moving forward. So here's what I want to point out. Yes, Google stock has seen a run up in the last month. And really, this isn't something that surprises me. Yes, markets can remain irrational for long periods of time, but the Google search portion of the business was being valued at an extremely low multiple, one that even in a bear case was certainly not justified. But even now, it still looks like there's upside, and like I pointed out earlier, the average analyst right now seems to agree. Let me know what you think of Google stock in the comments down below, and like always, if you'd like to download any of these spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.